90% of professional fund managers fail to beat the market over a 10-year period. Think about that for a moment. These are people with Ivy League degrees and supercomputers. Yet a complete beginner buying a simple index fund can outperform them by doing absolutely nothing. The biggest lie in finance is that you need to be a genius to build wealth. Most people think complex strategies equal higher returns. In reality, complexity usually just equals higher fees and more stress. The secret is matching your strategy to your actual skill level. What works for a professional will completely ruin a beginner. What works for a beginner is far too slow for a pro. But before you decide which camp you belong in, you need to understand how the latter works. What most people do not know is that the transition between these levels is where most investors lose everything. They try to leap before they can crawl. Let us start at the very beginning with the baseline strategy. This is the foundation that everyone must master first. If you are just starting out, your biggest asset is not your intelligence. It is your time. The beginner strategy relies entirely on passive index investing. This means buying a tiny piece of the entire global economy all at once. You do this through exchange-traded funds or mutual funds. The most famous example is an S&P 500 index fund. This tracks the 500 largest publicly traded companies in the United States. When you buy an index fund, you are betting on human progress. Historically, the stock market has returned about 10% per year on average over long periods. Imagine you start with just $1,000. You add $200 every single month. After 30 years, you do not just have your savings, you have over $400,000 due to compound interest. The absolute best way to do this is called dollar cost averaging. You invest the exact same amount of money on the exact same day every single month. You do it when the market is up. You do it when the market is crashing. In fact, you should love it when the market crashes. A crash just means your monthly contribution buys more shares at a heavy discount. The mechanism here is completely automated. You set up a direct debit from your bank account to your brokerage. You choose a broad, low-cost index fund with an expense ratio below 0.1%. Then you close the app and forget it exists. The actionable insight here is total boredom. If your investing strategy feels exciting, you are probably doing it wrong. But before you think this is all you ever need, the surprising part comes next. While passive investing is perfect for building foundational wealth, it will never make you rich overnight. It is a slow, steady 30-year march. As investors gain experience, they naturally want to accelerate their returns. This brings us directly into the intermediate realm. Intermediate investing is where you transition from passive passenger to active driver. The core strategy here is a core and satellite approach. You keep 80% of your money in those safe, boring index funds, but you take the remaining 20% to hunt for outperformance. This is where you start buying individual stocks, sector-specific funds, or real estate investment trusts. To succeed here, you must master fundamental analysis. You cannot just buy a stock because you like the product. You have to look under the hood. You need to read balance sheets and income statements. You must understand concepts like the price-to-earnings ratio. This tells you how much you are paying for every dollar of a company's profit. For example, an intermediate investor might notice a massive macro trend. Let us say you see the unstoppable rise of artificial intelligence infrastructure. Instead of buying a broad index, you look for the specific companies supplying the chips and power grids. You are taking a calculated gamble on a specific sector. This requires real work and emotional control. You need to spend hours researching companies every single week. You also need to accept that individual stocks are highly volatile. A single bad earnings report can drop a stock by 20% in a single day. If that thought makes your stomach churn, you are not ready for this level yet. By the way, if you are finding this breakdown helpful, please hit that subscribe button right now. We post deeply researched financial breakdowns constantly to help you move up the wealth ladder. Now, back to the strategy. The intermediate level is highly lucrative if done right, but it has a massive ceiling. Before you skip to the end of the video, you need to understand that professional investing is a completely different sport. The pros do not play by the same rules as the rest of us. When you reach the professional tier, you are no longer just picking stocks. You are actively managing risk, using leverage, and exploiting market inefficiencies. Professional strategies involve advanced tools like derivatives, short selling, and venture capital. One common professional strategy is long-short equity. A professional investor will buy undervalued stocks they expect to rise. At the very same time, they will short sell overvalued stocks they expect to crash. This strategy aims to make money regardless of whether the broader stock market is moving up or down. Another professional route is distressed asset investing. This means buying the debt or equity of companies on the brink of bankruptcy. The pro steps in, restructures the entire business, and sells it for a massive profit years later. This requires teams of lawyers, forensic accountants, and millions of dollars in capital. Professionals also use significant leverage, which means investing with borrowed money. If a pro has $10 million, they might borrow another $20 million to amplify their gains. If the trade goes right, their returns are astronomical. If it goes wrong, they can wipe out their entire fund in a matter of hours. To attempt professional strategies, you generally need to be an accredited investor. This means having a net worth over $1 million or a high consistent income. You also need access to specialized institutional trading terminals and prime brokerages. It is an environment where a single mathematical error can cost millions. We have covered the broad landscape today, but we have only scratched the surface. Each of these paths requires deep, specialized knowledge to execute safely. In our upcoming videos, we will dedicate an entire episode to breaking down each individual strategy step by step. You will learn exactly how to pick your first index fund, how to read a balance sheet like a pro, and the math behind advanced risk management. Do not miss out on those guides.